Hey traders, what's up? It's Sammy back on the channel, and today we're diving headfirst into the world of order blocks. You know those mysterious zones on your chart that supposedly hold the key to market manipulation and fat stacks of cash. But are they legit? Are they just trader folklore? Well, buckle up because we're about to separate the hype from the high profit. First, we want to ask ourselves what is an order block or what are order blocks? So, first thing first, let's break down the basics. Order blocks are the series of the last up close or down close candles before an impulsive move to the opposite direction. However, if you search on Google, what is an order block? What you get is quite different. Now on Google it says another block is a zone where traders place stop losses to protect positions from potential losses. When the price reaches this area, many of them can be triggered, leading to a trend reversal in shorter time frames. Other blocks look like a consolidation range. Well, in this definition, it's not really explaining what another block is. Well, I hate to break it to you, but other blocks are not a holy grail. They are not holy grails. Other blocks sometimes can fail, but the thing is, the way you understand other block is way way different from what I'm going to be explaining now. But first, let's take a look at what you understand as another block. Okay, so we have a chart like this, and let's say this is our liquidity, right? Our sell side liquidity. If we don't understand what sell side liquidity is, then you can go back to the channel and watch the video where where I talk about liquidities. So in this case, you see we are having a sort of downtrend like this, and price just reached a potential point of rejection on the higher time frame, of course. But what are we expecting to do here? We're expecting price to take out this low and return. Now, if it doesn't return, there's only one thing it can do. That's take out that low and keep going further. In that case, we'll not be looking to buy anything. But in this case, we wait for price to read that low, and you can see price readed that low. Now, in what you understand as order block is the last up close candle, but in the definition, I said it's the series of the last up close or down close candle. Now, I'll get back to that. But this is what I see a lot of traders do. They mark this last candle as their order block, and they wait for price to drop into that other block, putting their stop loss just below that low and the buy from here. Well, this I would say is over refined because in this case, a lot of times you're going to miss a lot of trades, right? And you see, price actually bought but did not pick you. So, what is the problem? What's the fault here? Well, like I said, a lot of traders use this as another block, but this is wrong. You want to check for the series of the last down close candle if price is taking out a sell side liquidity. If price is taking out a buy side liquidity, you want to check for the series of the last up close candle. Now, what do I mean by that? Well, check for the series of the last down close candle. So you see here we have a bullish candle, although it's a doji, and from here we have the bearish candle, and bearish candle leading to take out that low. So this is the series of candle that actually started the move to taking out that low. Now that is our order block. From that point down to the low, is our order block. This is what another block is supposed to look like. Although people fail to understand this because the risk to reward ratio here is going to be very small, and you're going to be using a very wide stop loss, and you know all of those things. But you want to see another block that have a series of a down close candle taking out a low, and also have an impulsive candles to the opposite direction. What do I mean by impulsive candles? You can see this candle leaving this area is impulsive. You have this green candle, the second green candle leaving what a fair value gap. Now, if there's anything you want to do there is to use this favorly gap as your entry. Since you've identified the other block, you use that favorly gap inside the other block as your what, as your entry. In this case, you don't have to use the beginning of the other block like this as your entry. You just have to use the favorly gap. So this becomes our entry, and you put your stop loss just below there. You're giving the trade enough room to breathe, right? And I take profit there. You can still get forex to a one ratio with that. It's very simple. This is what another block supposed to look like. Price tags you and hit your take profit. You can see this is very very simple. If you're waiting for price to reach for the last down close candle there, it's going to be a miss. Sometimes it doesn't even work that way. Sometimes it does, and sometimes it doesn't. But the key thing is finding your own time frame where this thing actually works. So you can go and backtest these things, and you will know what to do with it. Let's look at another example. Okay, now look at this chart. This is the 5 minute chart. Of course, you can also change time frames to the 15-minute chart. But I want to show you guys something, how to track order flow, especially in the New York session. Tracking order flow in the New York session is way easier than tracking order flow in the London session. This is because London session mostly does the manipulation of the day, while New York session does the distribution. As the London session will likely do the fake move. Let's say price is supposed to be bullish that day. Let's see for an example. So this is the beginning of this day, which is a Monday, and at this point you don't know where price is supposed to go, what price is supposed to do. We have price bullish at first and then bearish second. That's only in the morning. Now what this does is that this is the noise every day carries. I don't know, but some people trade London session very profitably, but what I'm trying to say is that most of my students avoid trading London session because of this particular fact. London session, you have the fake move, and in this case, price faked to the upside and then later faked to the downside. So, what happens in New York? Well, in this case, price took out sell side liquidity, and you know what happens? You're waiting for New York to open. So, when once New York opens, how do you track the order flow? Well, I track order flow using order blocks, and it's very very simple. Let's see New York. Let me apply my market session indicator. Let's see what New York does. Okay, so that's New York there, and it just keeps going higher. But we're going to track this order flow real quick, and New York closes there, right? So what happened in this case? So you see price takes out this sell side liquidity, and like I just showed you a few minutes ago in the first example, where's our order block? I know of course you want to use the last up close candle as your order block, but even though price tags this one, does not mean that that is the valid order block. You understand what I mean? This is the series of the last down close candle before an impulsive move to the upside after price took out a liquidity. You can note that down. Now, price taking this, dropping into the other block, that is your original buy trade at the beginning of New York session, right? Now, how in this case would you pick re-entries? Let's say you want to take re-entries, and you still use the same, you track the order flow. In this case, you track the order flow. Okay, so let's track the order flow of this session. Now, after price retraces back, what happens? It drops another series of down close candle before an impulsive move to the upside. Now, this is what I'm talking about. You can see that price dropping into the other block. You can see this one, price dropping into this other block, and price dropping into the other block. Of course, if you want to use the last up close candle, you might likely miss that, right? This is what price is using. Now let's say that is our second entry. Of course, only in just one session, that's our second entry. Stop loss at this low, and that. Okay, so now where is our next order block? Now you can see this is a retracement, right? And the series of this down close candle before an impulsive move to the upside. Although this move is not really impulsive, but that's another flow, other flow check there. So you can see that price drops into this, breaks that high after this retracement and trades back into the other block, making that other flow valid. And this is still your trade. Stop loss on this low, of course. Then take profit at whatever high, whatever your the left part of the chart is telling you, whatever high is there could be your take profit, right? So this is exactly how to trade order flow. Now you see in this case, if you want to use the last up close candle, price might likely not come for you. You understand what I'm trying to say now? So other blocks is not really what is out there on a lot of channels, or what all these trading gurus are saying. As the last of close candle, you need to refine your trades, you need to make your other block very small, because I see a lot of people do something like this, making this other block very small. But trust me, this is not realistic. Of course, you only do this after the trade have played out. You don't take trades like this. Many people just want to do this to fancy their charts and stuff. Your other blocks should be valid, and you should put your stop loss in in an invalidated zone, which is that low. What happens after putting your stop loss at that low? That's telling you that price is not coming for that low. You see this low, price is not coming for this low anymore. Price is not coming for this low anymore, and price is not coming for this low anymore. Why? Because price have checked the other block and the other flow is tracked. I don't know if you understand all I'm trying to say here, but I believe you now understand the truth about other blocks, and you no more be using it the wrong way from today. There you have it, folks. The truth about other blogs is that they are neither holy grail nor market voodoo. They are two like any other, and their effectiveness depends on your skill and understanding. So ditch the hype, embrace the reality, and use other blogs wisely to navigate the market with confidence. Remember, trading is a journey, not a destination. Keep learning, keep practicing, and never stop refining your skills. And while you are on that journey, hit that subscribe button and smash that like button for more trading insight and market madness. Until next time, stay focused, stay disciplined, and remember, profits are out there waiting to be claimed by the savvy trader. Peace out.